guys, hello and welcome back to Green Pips FX. And on today's video, guys, I'll be talking about fair value gaps. Right, this is a concept that I've been liking to share for quite a while now, but the day is finally there. Right, so what's a fair value gap? Right, and how can we use these fair value gaps to our advantage once we understand what they are? Right, um, so to start with, a fair value gap is simply the space left when the wick of the first candle and the wick of the third candle do not meet each other. What do I mean by that, right? So we have a series, of candles, assumingly in a downtrend, right? We have candle number 1, candle number 2, and candle number 3, and they both have wicks. All right, so we have the first candle here, we have the second candle here, and the third candle here. Now, a fair value gap is that space left behind when the wick of this first candle, I mean this wick here of this first candle, and the wick of the third candle, I mean this candle here, the wick of the third candle is this one here. The space left when these two candles don't meet, right? This candle here and this candle here. This space left behind in here. So we could just draw a box here, right? There. This is a space left behind. Okay, we could put arrows. I think arrows would be these rays would be more effective, right? So right there, right? So this space here left behind, this is what we call so let's just put the text there and indicate what it is, right? This is what we call a fair value gap, right? An FVG. Now we know that what a fair value gap is. So how are these fair value gaps formed, right? So if we have a series of candles pushing like that, right, in a downtrend, right, a fair value gap, this space here is left when the momentum of price in that particular direction is very strong, such that, right, because if price is pushing very bearish, right, in a very high bearish momentum, right, then the bulls will not be able to fully contemplate and close this gap here, right? So in the end, it will just be so let's say the wick ended here, right? Ended somewhere here, and then we have this area here. So in order for this gap to be filled, then price needs to make its way back here, mitigate here, and then leave, right? In order for it not to leave a fair value gap. But if the momentum of this bearish trend is very high, then price will end up making a slight pullback. Boom, slight pullback, drop, slight pullback, drop. Hence, this is how these fair value gaps are created. They're created when the market has a very strong momentum pushing towards a certain trend or a certain direction. So, how can we use this to our advantage as traders, right? So, fair value gaps can be best used when aligned with order blocks. So if for example, right, so per se that this right here is an order block. This right here is an order block, so we can just put this box to have a template. Yeah, we can just put this box back to normal, right? So if we have an order block resting here and we have a fair value gap below that order block in this bearish trend, right, saying that we have a low, a high, and a low, right? Sorry, let's push this a little bit to the side. So we have a high and a low, and then we have an order block that we want to see price retrace to and trade from there, right? Fair value gaps can be used to our best advantage at this scenario here. Why? Because if we have an order block that is unmitigated, right? So this is the area that smart money bought very hard before they sold even harder. So we now know that there are orders in here, right? So there are buy orders and then there are sell orders, right? So at this point, we now know that there are buy orders here, still not yet closed. Why? Because price pushed bearish with a very high momentum, leaving this fair value gap here. So this acts as an addition that increases the odds of price making its way back here through that pullback, filling this gap here, as well as mitigating this overall order block in here before price can now continue with its downtrend and make new lows. So this is how we contemplate and use fair value gaps to our advantage, right? So let's now go to the charts and see how exactly this works. So let me just remove these, and there I will be Okay, so let's now go to the chart. So I'm on the Euro USD on the hourly chart, right? And mind you that these fair value gaps, they always exist in the market, regardless what time frame are you using, regardless what time frame are you on or what pair are you on. If it's a stock, if it's anything, fair value gaps always exist in price. So with this with this current price action here, with this information that we're seeing here, right, you can now clearly see that we were formerly in a bearish trend, right? Price made a lower high, lower low, right? Lower high, lower low right here. This is just a liquidation move, lower low, and then price came off and broke this lower high here and created a higher high, right? So with the creation of the higher high, we now know that price has particularly just shifted its direction from bearish to bullish. So we have this right here as our change of character from bullish to bearish, right? I mean from bearish to bullish, sorry. And from there we can, let's just make this a little bit big there. And from there we can now seek for that area of demand or our bullish order block from which we want to see price retrace to before making its up move to go with the trend. So this is the area that I was looking at, and why this area, right? So let me explain why this area. So what we had, price had an up push from this area here. Price came up, came down, did that liquidation, made an intermediary break construction here, probably in the 50-minute. This is a very clear break of structure, and a retest in this demand zone in here. And then price made that bullish push, the extension, to take liquidity above this high, came down, formed another liquidity low in here, and then made a higher high, right? So this high high being formed, and now we have a liquidity low resting behind here. This is the area that actually caused this bullish push that took liquidity here. Probably in the 15-minute chart or the 5-minute chart, this could have been a break of structure. So from there, we now know that our area that price last sold and bought really hard is this area here. In support to that, we can now clearly see that. So let's zoom in and let's zoom in, right? So judging by the concept of mitigation and fair value gaps, right, we can now see that everything from this low here to this high here has been filled, right? And price, within making this low, made this extensive bullish push and left what? Imbalances, right? We can now see imbalances where there's imbalances or fair value gaps, right? It's the same thing from there to there, right? There's a clear space left between these wicks, right? It's clearly seen, right? So that can allow us to further refine this zone to this little man down there, right? So this is the beauty of using fair value gaps, right? So we can now refine our demand zone or our bullish order block into only this little man in here, leaving behind this space up here, which we know that from there we have an unmitigated order block resting here, and above that order block there's what? There's a fair value gap, right? So there's more than enough reason, after making this high here, price to make its way all the way down here to do what? First, fill this fair value gap, and second, to mitigate this order block here, right? Taking all those orders left behind by smart money, and then continue with the extensive bullish push to make a new high. Right there, right? So this is the piece of information that I was needing to share with you guys. Now, with that being said, I hope this video was very informative to you. And if it was, then don't forget to like, subscribe if you haven't, turn that bell button on for notifications. And until the next one, guys, stay safe, have a nice trading week, and peace out.